Hi, everyone. This is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. As we do each and every week, we show you the stocks on the screen that'll be featured in this recording. And if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this recording. We are doing the recording on Thursday night, and as you probably know, Friday is a holiday for the July 4th. So happy Independence Day, everybody. All right, let's take a look at the charts. So as we go to look at the charts, I found it interesting that there were some comments in last week's U.S. market update talking about Elliott Wave, etc. And if we go all the way back to the February highs, which is where we thought we were going to go and where we are in the markets now, but you notice there was a pretty clean single zigzag on the way down. So we had the A wave, we had roughly a 50% corrective move, and then we went down to the 100% extension. We continued all the way on down right to the 161.8% extension. And that's what happens with zigzags. If you go past the expected target, if you get an extended C level, you go to the next fib level. So that worked out to a T. And then from there, where the April lows were that coincided with the tariff tantrum low, we went through a series of zigzags, which I've talked about over the last couple of weeks, and we ended up with 4 different zigzags. So we had the original one starting from the tariff tantrum lows, and while we were going through that, we had 3 other zigzags, creating one of the most complex C waves I've ever seen in a zigzag. And just, for added measure, we had a triangle in the C wave of one of the zigzags that made it even more complex, and they all were converging. Look at the 1, 2, 3, 4 C's. There's all the 4 C's of the C wave extensions right there at those February highs, which is right where we were until today. And then we broke to the new highs. And as we broke to the new highs, now it brings up the question, where do we go from here? And that's going to be quite interesting, because over here you can see this conglomeration of C wave extensions. These are all fib levels, Fibonacci levels, act as support and resistance levels. So anywhere in between here is where we could find the final move in this wave 3. And you may notice that if you've been watching for the last few weeks, we didn't have this 1, 2, 3. But as a reminder on Elliott Wave rules, every 5-wave pattern starts with a zigzag. Not every zigzag turns into a 5-wave pattern, because the C wave has to extend 161.8% of the A wave to turn into a 1, 2, 3. And that's what happens. So not every zigzag will do that. Not every C wave extends that far. So not every zigzag pattern turns into a 5-wave pattern, but every 5-wave pattern starts that way. And this has been textbook Elliott Wave ever since the February highs. I mean, you could, if Elliott were here, he would put this in a new book on where we're going. So then to add something else to this, you can see this ETHW AI. That's the AI signals from the HUBB organization. And by the way, if you haven't gotten a copy of the software, you can get it by going to HUBB.com, HUBB.com. Get a copy of the software for free. You get Elliott Wave for free. You have the opportunity to subscribe to these AI signals if you want them, but the software itself is free. But when you look at this little pill-looking thing here, you can see it's 62%, and it gives a target of 652. So basically the AI with over 300 data points that they don't give us the algorithm. That's proprietary to the HUBB organization, but they give us the results of the signals. Is telling you it's a little more than a toss of a coin, so 62%, that will go to 650. Maybe we get there, maybe we don't. But there's a lot of potential Fibonacci spots in the way. So it's going to be super interesting to see where we move from here on the S&P. I'm going to jump to the VIX right now, and then we'll go through the rest of the markets. But as we take a look at the volatility index as evidenced by the VIX, been talking about this 17.5 level for a while. We've broken below that. Now we're testing 15, and we're in a holiday shortened week. So you would expect the volatility to be sideways. It was a quiet week. Maybe we get a little more volatility to start the week after the holiday weekend. We'll have to wait and see. But if we do break below 15, I think we go down to 12.5, which is where we were right around this point in time last year. Because the summer, you've heard the term summer doldrums. Normally the summer is a quieter part of time, usually the less volatile part of time. maybe that'll happen again unless we get some unexpected news event. So if we do break below 15 as we're moving towards the midpoint of the summer, that could propel the markets higher as well. So we might have a little volatility kicking in there as well. Let's actually ask a question tonight in our insiders meeting for alert subscribers at ewotrader.com. Are you surprised that with everything that's occurred with the war between Israel and Iran, et cetera, that we didn't have a higher spike in the VIX? And my answer was yes. I am surprised that we didn't break 22.5 with everything else that's been going on. If a war doesn't do it and all the other news events that we've had, the war of words that's going on between President Trump and Elon Musk, and now the Fed Chairman Powell saying that, oh, yeah, well, we would have cut rates by now if it wasn't for the tariffs. So I felt like that was a shot across the bow back from Chairman Powell to President Trump. So with all this stuff going on, the market's just yawning as far as a volatility standpoint. So perhaps we continue there. Let's jump to the bond market. As you know, that's what I've been watching to see where things go. As we take a look at the TLT, this is the prices on the 20-year. Remember, prices and yields move inversely. So on the TLT, this is prices. And we've had this just basic plain, we talk about Elliott Wave and zigzags and Fibonacci levels and all these cool things, but sometimes just old school technical analysis works. So you got a trend channel there connecting higher highs and higher lows. And we've just been drifting up through that trend channel on the TLT. And when you have a zigzag that completes, rule number one is that the C wave gets retraced. That's where we went. We finished this C wave to the downside at the 138.2% fib level, and we moved all the way back up to that B wave. So we retraced the entire C wave. The next step, if you continue in that same direction, is you retrace the entire zigzag pattern. So perhaps we come back to the 0 point, the beginning point of where that zigzag started, and that brings us back to about 90 on the pricing of TLT. You can see we closed near the bottom of this trend line. So the beginning of the week is going to be interesting to see what happens in the bond market. Do we break down here? Do we break out of this trend channel, or do we bounce back up and stay in it and march towards that 90 level? I know a lot of you like the TNX. You always ask about it if I don't show it, so I'll show it, and then you can see what happened here in the 10-year. So this is yields on the 10-year. So yields were coming down. So this is the opposite of TLT, which is prices. Yields and prices move inversely. You can see we actually had a tick up. I felt it was interesting today to see interest rates kind of tick up, and yet the markets finished near their highs of the day. Doesn't usually work out that way, but that's the way things occurred today. I ask you all the question, where would you rather be? Would you rather be trading the DIA, the Dow, where we had catch-up phase? So we had this triangle pattern right at 420, which was support, the main support level at 420. And we also had the 50-day moving average right at 420. So we broke above it. We created a wave 3. We came down. The wave 4 was situated here. We had all these things converge for a bounce off that 420 level. That seemed to be in play. And it felt like we're probably going to move up here to 450 rather quickly, which is exactly what happened because that's the next level of resistance. That was the February highs. The Dow was trailing what was going on in the S&P. So I said, would you rather trade the DIA or the Dow? And I'm not much of a Dow trader. I do like the S&P and the Qs. Or would you rather trade the Qs, going over to the Qs that were breaking the new highs? So both of those have clean air. They have no resistance in the way. So the DIA had no resistance up to the 450 level where the February highs were, but the Qs had gotten here first and they broke above the February highs, which meant they got no resistance on the way up either. Which would you rather trade? Well, it turns out you would have been a winner either way. Whether you traded the Qs or the DIA, they both worked. Maybe the best solution was trading a little bit of both. That would have probably worked out the best. So I found that quite interesting. I'm going to come back to the rest of the markets in a minute, but before that, I do want to go to the dollar. And we've been talking about the dollar a lot during TradeFinder. And if you don't know what TradeFinder is, if you're a new viewer, we do this every Tuesday at 1 p.m. Eastern Time. It's free. You can join by the link on the screen that you see now, or you can go to ewotrader.com and click on the link there. So we do it every Tuesday at 1 p.m. Eastern Time. Once again, it's free. We talk the markets, we look for trade ideas, and we have a live Q&A. There's a great community there. They chat back and forth during the broadcast. They ask amazing questions, good stock symbols, etc. It's a great community to be a part of. Love to have you at this week's Trade Finder on Tuesday. All right, so back to the chart of the dollar. And what I was talking about in there, to the point where some people were making fun of me because I would always say this: we don't want to lose a dollar. We don't want to lose a dollar. I didn't want to see the dollar break 97.5. I really didn't. I did say, though, that if we broke 97.5, and this is what they were talking about on the financial networks this week, would, interestingly enough, is if we broke 97.5, initially it'd be viewed as a good thing. It'd be viewed as a positive in the equity markets because so many companies have international exposure now. So it helps to the bottom line with exchange rates, right? Currency exchange rates. So it helps the bottom line for profits. But if we continue down in this wave 5, which we do have labeled now, or at least the software has labeled it. And by the way, this HUBB software labels Elliott Wave exactly to the algorithm as Ralph Nelson Elliott wrote it. Is showing that we could come down as low as 92.5 on the dollar. So my commentary has been initially be viewed as a good thing, but if the dollar continues lower, at some point, questions are going to start to arise of, oh, what's going on? Is the dollar not the currency of last resort anymore? Are people worried about the amount of debt the U.S. has, etc.? I do think at some point in time, to further my point here, if the dollar does continue down to the midpoint of this tap box, time and price projection, that's what those lines mean with the wave 5, we are going to start to hear those wonderings of, why is the dollar weakening so much? Are other countries dumping their dollars? We know they did some in the whole tariff negotiation thing. You know, they showed their hand. Our administration was adding tariffs, and other countries were dumping dollars and not buying as many bonds and treasuries, etc., which has all seemed to go away, except the dollar has continued down. So we've had bond prices go back up and yields come down, but the dollar is still going lower. So something's going to change there. I'm not sure what it is, but if we continue to see this eroding dollar, I think that could be a little bit of a problem for the bond market and therefore the equities market. That could tie in. All right, let's get back to our equities markets. So we looked at the Qs, we looked at the DIA. Now let's take a look at the IWM, the small caps. And we had talked about this during TradeFinder as well. Oddly enough, this was one of our TradeFinder considerations. I did feel that if we could get a bounce to the upside out of this triangle, we had the chance to go to 220. Well, we broke out of the triangle. We came back and tested the point of the triangle. Classic consolidating triangle rules through Elliott Wave. Test the breakout. You're always going to test the breakout, just like filling gaps. Gaps are going to get filled. We don't know when, but we also don't know when the test of the triangle breakout is going to occur. But sometimes it occurs immediately. Sometimes it takes some time. This time it occurred rather quickly, and we broke back up. And now, since we're above 220, I don't really see anything stopping the IWM from going to 230 now, which does coincide back with the next point of resistance, which was the IWM's February highs. Now, we are a little bit overbought from the 10-day moving average, a little separation here on Thursday's move. Maybe we need to rest for a day or two at the beginning of next week, but I do think we see 230 on the IWM in the not too distant future. I just don't know if it's going to occur at the beginning of the next week. All right, now let's go ahead and take a look at the metals. We'll look at gold, GLD, in this massive triangle. I really like this pattern. GLD does this all the time. I've talked about this numerous times. It consolidates, breaks out, consolidates, and breaks out. It does it just repeatedly. And now we have a nice big triangle with the lows called around 290 and the highs up around 320. So the mouth of the triangle gives you the potential breakout. So call it roughly rounding a 30-point move is going to come on GLD, but we don't know which direction it's going to be. Elliott was really clear on this. pardon me, that no matter what the Elliott Wave pattern shows, a triangle trumps everything. It can break any triangle, can break either direction, ascending, symmetrical, or descending. Any of those triangles can break either direction. I had somebody write in once that said they were told that triangles broke to the direction of the flat line. In other words, if you had an ascending triangle, it broke to the direction of where the upper part was, the horizontal part. If you have a descending triangle, then it would break to where the lower part was, where the flat part was. That's just all marketing stuff. That is not, I can tell you, I have the data and the AI people at HUBB have backed me up on this. Any triangle can break either direction, but I do know GLD is going to break out. Let's look at SLV, which we talked about. Could this play catch up? And it did for a while. We had this breakout move here from its own triangle that occurred. So we had a vertical breakout, a couple sideways days. We broke up vertically again, went sideways again. Now here's another one. This was on the AI signals as well from the HUBB organization, a 71%. So pretty high score. Normally we send out alerts at 75 or above, but I kind of like 70 or above. And look, that's where the target was. So it went and flatlined exactly where the AI said it was going to go. And now we're sitting here and we had a little bit of a break up today. So is SLV now starting to take the lead from GLD? We thought it was going to play catch up because it hadn't had quite the move GLD did. Now is it going to lead GLD on a continued move to the upside? That'll be something to watch at the beginning of next week as we move to the energy markets, looking at natural gas. Oh, did you see the news? This was really wild on the news of natural gas. So we had this big breakout move here where all of a sudden the realization came that all of these data centers are going to be run on natural gas. And even though we are the Middle East for natural gas in the US, we have tons of supply. Is demand going to outstrip supply? That's how the markets move. The markets move on supply and demand driven by fear and greed. That's it. That's how the markets move. We just try to figure out how we can assess that and analyze it as technical traders. So we had that move up, and then it came back down where people were thinking, well, wait a minute, how long is it going to take to build all these data centers, and how much natural gas actually are they going to use? And so that five-wave pattern to the upside got retraced exactly as it should have. But now what they're talking about, and I actually had given this out last week, I thought we would bounce up from this support level at 15 on natural gas, and we did for one day. We had, I would call it a day and a half. If I spread the chart out, you can see where we had this day right here where we opened, traded down, hit 15, closed at the high of the day, had an up day the next day, and then now we're right back down at 15. You may have seen this. There's a company or a couple companies out there that are using a lot of those recycled batteries from electric vehicles, which is what I was wondering. How are they going to dispose of all these batteries? We'd always talk about, earth-friendly things, etc. What are they going to do with all these batteries from the electric vehicles? Well, this company is out there and they're building fields of these batteries, just like you see acres of land with solar panels. They have acres of land with these batteries that can also power the data centers that are going to be doing all this data mining for AI, etc. That doesn't sound like that's going to be helpful from the demand side of things for natural gas if there's another alternative to it. And, how cheap are the batteries going to be? You buy a bunch of old used batteries and recycle them. Maybe that's cheaper than natural gas. So I don't know where the catalyst is to move natural gas higher is what I'm trying to say. We're down here. We did pierce the top of the tap box here in the wave 5. Maybe we drift a little bit lower, but I don't know where the catalyst is to move natural gas higher now with all that. If we look at oil as we move into, we are in peak driving season here in the summertime. You guys know the story here. I've been talking about this forever. I felt like 60 to 80 is where the trading range was going to be for the balance of this year. I said it right at the beginning of the year. And other than the outlier here when that Israel-Iran war started and Iran was talking about potentially blocking the Straits of Hormuz and all this kind of stuff, it put a pretty quick bid into USO. But just as I talk about all the time as well, no security in any time frame goes too far from its 10-day moving average. Oil's the same. And what goes vertically up oftentimes comes vertically back down. Both of those occurred with oil. and now we're still in this range. We're in the upper end of it, but I think OPEC Plus now, as they call themselves, is happy with oil being slightly elevated. They don't want it to get too high. They don't want to push people into electric vehicles, but they don't want the price of oil to go too low either. And they had actually said in the height of this conflict between Israel and Iran that they had the capacity to produce 3 more million barrels a day, but they had no plans on doing it. They said, we could do it, but we're not going to. It's because they want the price of oil to be elevated. So I don't really think there's much more to talk about there on the price of oil. So let's go and take a look at the crypto space. And this is pretty interesting. I look at BITB. I know a lot of you have said you prefer IBIT. Both of them have very liquid options, which is what I like. I like to trade options because of the leverage. And it's pretty similar. I've compared the two. Just have a personal preference to BITB. Not that there's anything wrong with IBIT. They're both good. We had the triangle. We broke down. We tested the 50-day moving average. No follow-through day. Another rule we talk about a lot. If you're going to break a major moving average, break out of a triangle, break a support resistance level, etc., you need a follow-through day. We didn't get it. It was just one day down here and then right back up above the 10-day moving average immediately. And now it looks like maybe we're going to try to move higher. If we can break above 60 here on BITB, something could really be happening in crypto land, at least on Bitcoin, because you can see, again, all that clean space. You get above 110,000 on Bitcoin, and it's off to the races, I think. And that is a potential. It's got to do it first, but that's something to watch over the weekend because, as you remind me all the time, Bitcoin trades 24/7. But it has a calendar rollover for ETFs like this, software programs that show end-of-day data, etc. And then if we go look at Ethereum, I'd mentioned this in the same vein as silver. Could it play catch-up? Because it was just lagging. We had the approval for the Ethereum ETFs, which this is one of them, ETHW, and it had all that buying, and then the buying stopped. And all of a sudden we started coming down. Well, there was a quiet period of no buying, and then we had the catch-up move. So we had a vertical move. We went sideways, looked like we were about to break down, and this was danger, Will Robinson for Ethereum because the vertical move was so straight up, there was no resistance to stop it on the way down. If we had had a follow-through day, which we didn't, we only had one day, and then back above the 50-day moving average on Ethereum, if we had had a follow-through day, we were likely coming all the way back down to 12.5, and it probably would have happened rather quickly, but it didn't. So we're back up in this little range here between 17.5 and 20. Call it 17 to 20 is where we are on the ETHW. We'll see if it can play catch up. So we're going to be watching Ethereum and watching silver. Those will be two of the main things to watch at the beginning of the week. Obviously, the bond market, always watch the bond market. And let's see what TLT does at the bottom end of that trend channel. All right, so that gives you energy markets, the gold markets, etc. Let's move into stocks of interest. One of the stocks you all have been asking about is Webull. So let's take a look at Webull, symbol BULL. And by the way, just as a reminder, every month this year, just like we did last year, we're giving away one of our free level 3 subscriptions at ewotrader.com. That counts the time strategy, which is sideways moves. We're looking at calendar spreads, butterflies, etc. Things that generate income from a sideways move. They're not big home run hits. They're just like consistent income generators. The volatility strategy, which is looking for breakouts of those triangles. Don't care which way the stock moves, just needs to move. And then the AI-driven impulse signals, which is primarily those zigzags within the wave 3. Now, all you have to do is leave a comment underneath this video, and you're registered if you're a subscriber. So hit that subscribe button. We're pushing 50,000 subscribers. Really want to get there. So if you're not a subscriber, hit that subscribe button. If you are, just leave a comment, and you're in the drawing. And it's worth thousands of dollars. You can go to our website, ewotrader.com, and see what that level 3 subscription's worth. All right, so let's go back and take a look at the chart of Webull, because boy, what an interesting chart this is, and a lot of people talking about it right now. They recently went public with a really high valuation, Robinhood's at you know, $100. It's at a really high level. And so Webull in the same place. Some of the commentary is that Webull is going to be the new Robinhood. Well, we'll see. But it didn't do much. And then, boom, a massive jump to the upside on the IPO. And then right back down. Once again, what goes vertically up oftentimes comes vertically back down. No better example than this chart of Webull. So right straight up, right back down. And then look, here we are right back at the $10 level. What I like to look at when you see a chart like this is volume, because as a quick reminder, the way the securities industry works is that if you are registered, your investment company, so mutual fund, etc., as your investment objective is growth and income, anything with growth in it, you can own stocks above $10. If you are aggressive growth, if that's your investment objective, then you can go down to stocks at $5. Other than that, you get down to the peak sheets, over the counter, all that kind of stuff. But $10 is the key level. That's where the majority of people are invested in mutual funds, etc. So you can see what's happened. We come back down to $10. Look, we had this big blast off here. Obviously, that was an institutional buy there. And then look what's happened recently as we're starting to move up. So there is institutional interest in this stock. I think Webull could be poised to move higher. And if you want to take a look, I didn't have this on the screen, so I'm kind of doing this off the cuff here on Robinhood just to show you where the stock went. There we are. There's that 100 level, that big round number. You can see there was pretty good volume there. Also some selling that came in once we hit 100. Is that what's next for Webull? We'll have to wait and see. Another stock of interest, Tesla. Holy cow, the war words between the administration and Elon Musk. You know, there's all kinds of speculation. Is Elon really that upset, or is he trying to bring back the people that got mad at him for doing Doge? All that kind of stuff. You've heard all those commentary. But what does it do for the stock? Well, we've got this triangle. We had a false breakout to the upside and then a false breakout to the downside. That doesn't happen. You don't get two false breakouts. So what does that mean? Well, it means you're forming a larger triangle. So we draw that lower trend line here, and then we draw the upper trend line here, which basically means we formed a larger triangle on Tesla. It still means we're going to get a breakout, and we still don't know what direction it's going to be, but you don't get two false breakouts. You can get a false breakout one direction, and then to get a big move the other way, but you don't get two false breakouts. So we didn't know that until the last couple of days when we moved right back up here. And look, the 10, 30, and 50-day moving averages all converging at the exact same spot, which is the point of the triangle. So you measure the width of the triangle, as I talked about before. So a little bit above, call it 360 and 260. There's about $100 move coming in Tesla. And I can't tell you what direction it's going to be, but there's going to be a big move coming in Tesla. So watch that. It's going to be really interesting to see. Then we go to Nike. It's another stock y'all are talking about a lot. Caught me off guard, as with a lot of people, kind of felt like Nike might be losing their shine just a little bit, if you will, with these moves down. And then we consolidated for a while, for a number of months. And then they shocked everybody with their earnings report where they came out with better than expected numbers. But look, we're a little too vertical now, too far from the 10-day moving average. So we've moved up too far, too fast. I'd be very nervous about Nike at these levels. I think it needs to do a little backing and filling here. Let's see if we can consolidate maybe somewhere around this 70 level. That makes sense because that's acted as support and resistance in the past. So let's just extend this line over. That's where I think maybe we get a little bit of sideways action for a while, and then we'll have to figure out what's the next move for Nike. But yeah, that was a surprising earnings report that they had. Good to see that they're back on the screen again. A stock that a lot of you have asked about in the live shows, SMCI. You know the story here. They're in the AI space. They make tons of money, but they had some accounting problems. Never good when your accounting firm quits. And that's what happened on SMCI right after they were added into the S&P. So they had the big move up on that, and then they had their stock split. And then right after the stock split, a terrible time for bad news to come out, that accounting stuff came out, and we just kind of labored around down here through April and May around 30. We've caught a little bit of a bid here. we got back above 40, and you can see that we have a nice smooth separation here between the 10, that's the lime green line, and the 50-day moving average, the royal blue line, as we're moving higher. What I want to see now is whether or not SMCI can break 50. If it can break 50, we might be off and running on SMCI. It's going to act as resistance. It did over these last few days. As you can see, we ran right up to it, came back to the 10-day moving average. That's a nice consolidation over about a week's time. But if we can break 50, something really might be exciting with SMCI. If not, then we're probably coming down at least to 45, if not all the way back to 40. So that resistance level is going to be key to watch. NVIDIA, everybody loves it again. There's so many people. We were actually talking about this before we did the broadcast. A lot of people saying, boy, if I could ever get NVIDIA again at 100, I'd buy it. Well, you did, but you did during the tariff tantrums when everybody was really worried about the entire market as a whole. How many people pulled the trigger and bought more NVIDIA? Well, if you did, you're really happy right now because we closed up near 160 at the end of this week. And we broke those highs, which were key. So you can see we went up, broke above, tested it. What was resistance becomes support. So you test that to see if that happens. And we bounced off that level and moved higher. The sky's the limit, really, for NVIDIA. That's what a lot of people say. And from a technical standpoint, that's the way I look at things. That's also true. There is no resistance in the way. So where this wave 3 ends on NVIDIA is anybody's guess. There's not really a zigzag here. So the argument in wave 3s on trading Elliott Wave is stay away from the wave 3 because you don't know where it's going to end. My argument has been if there's a zigzag in the wave 3, then the Fibonacci levels can give you a good idea where the wave 3 is going to end. But if there's no zigzag, I agree. Very difficult to know where the wave 3 is going to end. And there really isn't a zigzag in this pattern. So who knows where the wave 3 is going to go. But if I was long NVIDIA, I'd be really happy. If I was looking to get in, you might want to try to enter now. Maybe you hope for another test of 150. But if you're already in it, where your stop should be, in my opinion, is if you break back below 150. If NVIDIA breaks back down below 150, then that should be your stop, in my opinion, again, because I think 140 happens rather quickly unless you can stand that move lower. But the problem is if it doesn't hold 140, it's coming down to 120 rather quickly. So kind of interesting on NVIDIA. Sky's the limit, or you can see 120. So I know you guys don't like it when I give both sides, but that's prudent trading. You got to have you pick a direction, but you got to know what to do if you're wrong, because we're all going to be wrong. Nothing's 100%. No indicator is 100% right. No trader's 100% right. You need to know what you're going to do if you're wrong. That's why I talk about what could happen if a certain directional move doesn't play out. Look at Microsoft. Look at that move. I've been looking for an entry in Microsoft ever since it had it, just like Nike. It surprised everybody on these earnings. It was kind of left for dead. People were, Microsoft was seemingly in the news every day with a negative regulatory comment. And then it comes down here, it bottoms at 350, has a surprising earnings report, and it's just had this really nice melt up right along the 45-degree angle, right along the 10-day moving average, up to 500. That was kind of a easy target. It's one of those big round numbers. I call it the tractor beam effect. That's kind of a nod to my dad. When I was growing up, Star Trek, the original Star Trek was always on the TV, and I kept hearing that tractor beam, where the planets would draw the spaceship into it. Well, those big round numbers act like that. They draw the security to it. Well, we're there. We're at 500. Can Microsoft break 500? If it does, again, all this clean air. There's no resistance in the way. But 500 should act as resistance. It has for the past few days. But a break above 500, and who knows where that wave 3 is going to go, because it also doesn't have a zigzag pattern in it. So very difficult to figure out where that wave 3 could end. Netflix, boy, you guys either love it or hate it. It's amazing, the comments. I love reading the comments about Netflix. And my point is that they're more than a streaming service now. I give them credit because they are branching out and they're doing a lot of things right, and they're getting rewarded for it. people are looking at the stock and saying, just like Tesla's more than a car company, even Elon says, don't buy the stock if you're buying it as a car company. It's a whole lot more than that. That's where Netflix is going. And I don't know where their valuation could end. I don't know how anybody can value this stock. Some people have written in, some of you guys have commented that the stock's way overbought. By what metric? What are you using? Because all the industries that they're investing in and the companies that they're buying, et cetera, I don't know how you value them yet. So another wave 3 with no zigzag and hard to figure out where it's going to go. So people are long these stocks. And another thing that I've talked about to anyone that will listen is the odd environment that we're in right now. Normally, institutions rule, right? The big boys, and that's always been a criticism of the markets, is that the big boys control everything because they got all the money. Well, if you look at how much cash is available in institutions, in other words, deployable cash, how much can they put into the markets versus the amount of money that's in retail accounts in money markets, which is over $3 trillion, the retail trader, in a rare set of occurrences, is kind of in control right now. The stocks that the retail traders want are the ones that are moving, and they like those big names. They like the NVIDIAs and Microsofts and Netflix. They like those stocks because those are the ones they know. Those are the ones that they hear about. And it's difficult when it's a really interesting time in the market, especially for somebody like me that's been around a long time, to see where kind of the boat is shifted over towards the retail side. Pretty interesting. But when you look at Google, we're in this wave 5. We're nearing the tap box. The resistance level is up here at 190. That's right in the middle of the tap box. The upper end's at almost 200. If Google could make it to 190, is it really going to stop before 200 before it gets back to its February highs? I doubt it. Google, I think, is really, really interesting right here. So if you can get 190, I think you get 200. And then Palantir. Now, this was almost a kiss of death, right? Because everybody loved Palantir. And then President Trump mentioned them as being someone that the defense industry with the government was going to use. And then all the people that are anti, the country's split right now. We're not going to talk politics, but was that a negative for it to be mentioned like that? But it continues higher. It's holding above the 50-day moving average. We did hit the 10-day moving average on the high, so we bumped our head on the 10-day moving average. And look at that doji today. So Palantir will be one to watch at the beginning of next week. If you're long Palantir, I don't see any reason to get out. If you're looking to get in, if you're very aggressive, you could try now. But I think I would watch and see if we get yet another test of 125. But we did in May, and it tried to break above it, but now we're right back down. So if you're long Palantir, 125 is where your stop should be, which, oh, by the way, happens to coincide with exactly where the 50-day moving average is. And if you're looking for an entry, again, if you're very aggressive, you could try now. But in general rules, hard to go long a stock that's not above its 10-day moving average. So you might want to wait if you're slightly more conservative and see if we can get above the 10-day moving average. If you're very conservative, you would want to see that wave 5 high taken out at 150 before you got in. So when you look at this wave 4 is right at 54%, that could yield a wave 5 as high as 100%. So there's plenty of room to run here on Palantir if it does move higher. So we're kind of in an area of flux here, below the 10-day moving average, but above support. So you decide what your risk tolerance is and how you want to play that. And then last but not least, Apple, which just absolutely laid an egg at their big conference because everybody was waiting for them to move into the AI space. They didn't do it, but that didn't break the stock lower. We have this triangle here that we've been watching for a while, and even that wasn't enough to break Apple to the downside. I've always said, I say this a lot, Apple is the one stock I fear shorting more than any other because they have so much cash, and you never know when the board's going to initiate a stock buyback. They could at any time, and they have the money to run the shorts out. They really do. They have so much money. And so it's a very difficult stock to short. So when they laid such an egg at their tech conference, you would have thought that would have broken the stock to the downside, but it didn't. Well, now they're coming out and saying yeah, they are going to embrace AI. They want AI to drive Siri moving forward. I'm not a Mac kid, but a lot of people are. And so that seems to have excited the market, and it gave us an upside breakout from this triangle. How far can it go? Well, you would think that the next move would be back to this previous four. So around 225 seems to be the logical point for Apple to go. And then the naysayers are like, oh, that's not good news. They've got so much money. They've got so many brains there at Apple. Why aren't they generating their own AI? So even the people that are really staunch Apple supporters were angry about it, but the market seemed to like it. And that's all that matters, is how the market views things. What you think, what I think, doesn't matter. What the market thinks, that's how the markets move. You can either trade by the way you think markets should move, which I learned the hard way, or you can trade the way the markets move, go along with them. And that's what we try to do here. And that's what we try to do, analyzing the charts each and every week here for you. So have a great 4th of July. Happy holiday weekend, everybody. Look forward to talking again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also